Hi everyone and welcome to Boothy Bites, the monthly video series with the man himself, Mr. Chris Booth. How are you, Boothy? And more importantly, where have you been?
Hello, Jackie. Yeah, look, I've just realised I look very shaggy on the on the video. So I've been over seeing my mum and dad in England and family and friends, and did a hike in Scotland, which was beautiful, and been doing some walks on the Isle of Man. But obviously, I haven't shaved. And I just looked at myself then in this video call. I haven't been doing too many video calls when I've been away. And I do think I'd need to do some man maintenance. So there you go. And that goes to my belly as well, too many pints and pork pies.
Oh, but Boothy's Bites comes first, and then all of that, the grooming and everything is secondary. I like your priorities.
That's right. Yeah, good to be back, Jackie. Thank you.
Good. Well, let's start the way that we always do, with a check-in with the RBA.
Yeah, what a funny month. I mean, look, apologies, we didn't really sort of check in June, and the reason for that is that we didn't really have a lot of information to talk about. The Reserve Bank, their meeting was later in the month, which was and we're getting the commentary from that today actually. But interestingly, we had the inflation data for May as well, which has come in a lot higher than where the market and the economists in the marketplace were looking. So it was expected to be coming in at sort of 3.6 or lower percent, and the CPI for May actually kicked up to 4%, which is, look, that's not great. So we've kind of had this big trend pushing down, but we've had a bit of a blip now, right? So, and some of the trends in cost of goods is really impacting households. So it's, it's rent, it's food and beverage, it's beer. I'm not a smoker, but if you buying a pack of fags, I think that's going to cost you a bit more as well. So it's really meaning that the cost of living is still heavy and increasing slightly and above the trend that the RBA does want long term. So remember, this is a long game. So the goal here is to get the inflation below 3% over the next sort of 6 months. The trend is still definitely that way, but this blip in May will certainly be of concern for them. So really we need to start looking at what the June data looks, which is going to be at the end of this month, and then the next Reserve Bank meeting is going to be an announcement will be on the 10th of August. So they'll have 2 months inflation data being May, June. They'll have the quarter summary from April to June as well to make an assessment. And worryingly, if that blip is a second blip, well, then we could be on the cards for a 25 basis point hike, which is a bit of a worry. Anyway, yeah. So yes, but I mean, look, my gut feel is I think the hard yards have been done with the increases we've made. I'm hoping there's a bit of patience with that. But yeah, look, it's certainly a bit of a different time now.
Yeah, sure. And so, with this blip, and also now that we've clicked over into the new financial year, how will the government's fiscal policy impact the RBA's decision making?
Yeah, so I think it's been well publicised that the tax cuts that average Australians will get, there's going to be a few dollars back in the pocket. Again, that sort of cascading effect of the decrease in tax rates is going to be over the next few months. So rather than sort of a knee-jerk reaction by the RBA, just to hike rates to sort of mitigate that risk of increased cash in people's pockets, I think we're really on a wait and see. I'm hoping that we continue on this path to get to sort of Christmas. I think the interest rates that are currently set at 4.35% for the cash rate is appropriate. There's certainly a lot of household expenditure stress still going on. So I think if the RBA increased even further, it would probably make things very, very tough for many, many people. And if you think about what's happening overseas, they're actually starting to reduce interest rates. We saw the euro interest rate decrease last month as well. So I think the trend from sort of other Western societies that interest rates are being decreased are probably a little bit ahead of where Australia is.
Mm-hmm. Great. And so can you give us an overview of where interest rates are going now?
It's funny. So there's two things. So we've got the RBA cash rate, which is, it's a bit of a benchmark for us all. And that does, dictate where the variable rates typically are. But just remembering that the banks can increase their interest rates or decrease their interest rates outside of that cash rate. And one of the things which, they look at is the cost of the funds. Now, interestingly, we've got sort of the 90-day bank bill rate at 4.5%. So there's a bit of a risk premium there above the 4.35%, potentially, on that interest rate hike that we were talking about before. But then we've got the 3-year, 2 and 3 year interest rates closer to 4%. So again, they're kind of marking in the decreased interest rates over the sort of 6-12 months to get down to that 4%. I think we're still going to be having a flat interest rate. The other thing we've got to remember is that the full extent of the interest rate increases has been passed on to deposit holders now for many banks. So there's a bit of competition there. So the cost of the funds for the lenders has increased. And that's a challenge for the banks, where obviously they're looking at returning profits to shareholders, which they want to do. But they've got this now challenge where a lot of their retail products, the margins have been eroded by the cost of the funds which that they're borrowing at to then on lend out. So again, it's a bit of a challenge and a bit of sort of a balance as well.
Yeah, sure. And so how are the current interest rates affecting loan pricing and customer retention for the banks?
I mean, that being said, so in this market right now, there's not a great deal of cashbacks. I think many of the cashbacks offers a sort of lapse now, so that kind of attractiveness to move for a really low rate and a cash injection has kind of gone. So there's no sort of standout winners with lenders right now. I mean, we do have our favourites. So Bendigo Bank is one of our hot lenders right now who seem to be doing everything right. Their service is great. Their interest rates are good. Their products and policies are very, very good as well. So we are attracted to those clients for new business. However, though, the lenders are really, really, beefing up their retention team. So if you are thinking that you're out of the money with your interest rates, it's definitely worth a call either yourself or get your mortgage broker to give the bank a call and fight for a better rate. And certainly the retention teams are running hot and they're willing to discount interest rates to sort of something a little bit more competitive to save you some dollars. So my recommendation right now is, even though you're not looking to refinance, certainly keep your bank accountable for maintaining a good rate. Speak to your broker. It's the 1st of July. Let's check interest rates. Let's get back in and do some pricing work for you guys. Save you some dollars. It might be able to buy you a pack of fags if we save you some money. No smoking, but beer.
Endorse that. And so what are the current trends in the lending market for refinancing, budgeting and first home purchases?
Again, we're working with a lot of clients who've got maturing fixed rates still. So there's quite a lot of clients coming off crazily, 1.99% interest rates, which is, I'm sure they're going through the tough times right now, whereas many of actually are quite happy paying sort of 6.5% interest rates today. So again, we're doing a bit of refinancing for those clients. The other thing we are doing is like extending interest only periods for investment properties. And again, that's a credit application. So we're working with many just to get those budgeting and the structure of debt in the correct place again. And those people who sort of really doing it tough, and there's a bit of challenge in managing repayments. If there's the ability to sort of re-extend the term of the loan, we're going out to 30 years again for those clients to make the principal interest repayments a little bit less for those clients too. So there's a few sort of nuances we're working with. The first home market is certainly hot, and there's two parts to that. Number one, obviously from a media perspective, there's a real big focus on the cost of rent and the cost of homes and sort of shortage of homes, etc. However, interestingly, yesterday we got the new places for the first home loan deposit scheme, or the guarantee scheme, which is out there. So pleasingly, they increased the first home guarantee scheme for first home buyers if you meet that criteria, and just reach out to your broker for what that criteria is, from 10,000 people to 35,000 people. So that's huge. So if you're a young person or an old person trying to find your first place, and you meet the criteria for the first home guarantee scheme, I think that's a really good amount of savings you can benefit from by avoiding like lender's mortgage insurance. And obviously that goes in tandem with the other schemes out there from a state base as well, your first homeowners grant and also your stamp duty exceptions as well. So that first home guarantee scheme is a really, really that's a big push. An extra 25,000 people in market for that, which is huge.
Bring it on. Now, can you hit us with my favourite part of Boothy's Bites, the property update?
Okay, well, I'm no guru on property. It seems, in the main, property prices are going up. And I think we've talked about this a few times of late. We've got this first home buyer market, or, young people trying to get into their first home. And there's a massive amount of demand to try fit in that first home owner bracket, so you get all the benefits. That's sort of up to your $800,000 in metro cities. But then again, you've still got a lot of demand for people who are benefiting maybe from sort of mum and dad, got a larger deposit and trying to buy sort of that, that $1.5 million home as well. So I think think the increase in value for that price point is because there's a lot of demand from, in particular, first home buyers. And also, if you think about it, affordability from an investment property perspective for those people who are really aspirational, want to get on the first investment property rung or kind of continue to build their property market, that's kind of affordable space as well, So that up to $1.5 million is hotly contested. And we've seen over in Perth a big increase in property prices, which is, again, driven by, I think, investors, because it's an affordable city to purchase. You get, a high quality product. You probably get a house over there rather than apartment in New South Wales. So I think Perth has really benefited from that. Similarly, Adelaide is a strong city and a big city. They've also had the similar sort of benefit from that kind of investor stock as well. So you can buy a home over there, certainly sub $1 million, and rental returns strong and things for those cities. Talking about sort of Brisbane and Sydney, I think Brisbane's had a really big jump. I think we're still on the back of the Olympics there, that's charging ahead, and again from an affordable state, it's getting the uplift of that value. I think the other side to that equation is really with the post-COVID era. We've really run out of the COVID conversation now. It's kind of done and dusted. If you're an employee, your employer wants you back in that office working. And, if many people kind of moved out to the regions, where they could benefit from lifestyle, quieter place, connect to work via, the internet and technology and video calls. And they can't do that now. So, that 1 hour commute, 1.5 hour commute is no longer a viable thing to do. So I think we're starting to see a lot of people sort of relocate and get closer and get back to back closer to their work and their office again. So I think notably their Hobart and Tasmanian property prices have fallen a lot, where they benefited from that sort of lifestyle of through the coronavirus period. So it's interesting. And then the higher value properties, I think that's sort of a mix and match. Affordability by the banks is certainly tight. So if you're wanting to borrow more than $2 million, you need to be a pretty high earner. So access to those property, if you've not got capital, is tough to borrow. So again, that's a tougher market. But yep, that's my property snapshot.
Love it. And if you'd like a deeper dive on that, make sure you tune in to the new property update that I co-host with Tom Haig from My Money Sorted, and that gets pushed out monthly as well. So there's a little
plug, yeah. And I love it. I think it's great. Everyone wants to talk about property, and I'm not that specialist. Debt's my thing. I chat with Tom all the time, and he's great. And we've got other people in our network who have got sort of local specialist knowledge as well. But certainly that little bulletin you're doing, Jackie, is invaluable for our clients. It's a quick, short burst to catch up from the month, and then do reach out to, well, you can call Jackie to find out what's happening in Brisbane, right?
Give me a call. I know what's going on. And so last but not least, can you give us a quick update with what's happening at Lydian HQ?
Yes, I can. So all guns are blazing. So it's Lydian 2.0 right now, Jackie. So I think we're just over 3 years in business, or 3 years in business. This is our sort of trigger event. But, beautifully, we've got a really good national network of brokers now. We've just complemented that with another Sydney broker, a good friend of mine who I worked with like 15, 20 years ago at St. George Bank, which is great. So he's going on his banker to broker journey, and that's Stephen Spanton. Definitely well equipped to do business lending, corporate lending, SME lending, and also your home lending. So he's a good addition to the Lydian team. We've boosted the VBP team as well, our operations team. So we've got 4 new guys working for us over there in the Philippines, and excitingly, we're going to see them next month, aren't we, Jackie? So that should be pretty cool. So so we're boosting the work that we do for the brokers, and what that does then frees up the time to get out there in the network and build better relationships with partners and start kind of building their networks as well. And I want to say a big shout out to yourself for last month's partner catch up, the Mark Dunsford episode and Dunsford Financial Planning, and the kudos to Jamie Gant in particular, one of our great brokers who's been pretty much with us from day one. It was a real good showcase of why we do what we do, Jackie. So I don't know how you did it. You got the best out of Mark, but yeah, a really good partner update. So thank you.
Oh, thank you. And if anyone's watching this and would like to come on the Just Jackie partner interview bandwagon, please hit us up, because we would love to interview other partners. So, Boothy, thank you so much for your time, and we'll see you next week.
Yeah, I promise you I'll be a little bit more clean shaven and tidy, looking rather like a grandpa. Anyway, see you later.
See ya. Thanks. Bye.